This is Japanese Economic Review Channel.
And we are definitely looking at a pretty wild setup this week.
Oh, absolutely. Imagine like a multi-billion-dollar spring, right? Coiled so tight that just a single data point from a factory in Taiwan or maybe a tiny shift in a U.S. inflation metric could make it just completely snap.
Yeah, that is exactly where the Japanese stock market finds itself right now. It's in the state of high-stakes paralysis.
Totally. Welcome to this video broadcast where we're doing a deep dive into the official, recently published statistics forecasting the week of August 10th to August 14th, 2026. The title of today's deep dive is The Domestic Weekly Outlook.
Right, and we're looking at the raw data published just as the market closed heading into the weekend. And it reveals this environment where multiple massive macroeconomic forces are just essentially deadlocked.
Yeah, they're frozen. And our mission today is for you, the listener, to really decode that paralysis. You're here because you want to understand the current wait-and-see mood gripping the Tokyo Exchange.
Which is very heavy right now.
Exactly. So we are going to explore this fierce sector rotation, right? This massive tug of war between the, astronomically valued tech stocks and the suddenly surging domestic sectors.
And of course, map out the crucial economic indicators dropping this week that will undoubtedly shatter this current stalemate.
Right. Okay, let's unpack this.
Well, what's fascinating here is the sheer technical tension visible in the top-level numbers. Like, if you look at the published statistics for the close, the Nikkei sits at 65,606.71.
Which on paper, that's a solid weekly gain, right? Over 1,200 points.
Yeah, exactly. And the TOPIX closed at 4,074.93. But looking past that headline gain, the index is just slammed into a brick wall right at the 65,000 yen mark.
It's just stuck there.
It is finding incredibly stubborn resistance, and the technical indicators show us exactly why.
Yeah, the technicals are mapping out a classic volatility squeeze. Right now, the 5-day, the 25-day, and the 75-day moving averages are all converging precisely around the 65,000 level.
Which is rare to see them all pinch like that.
Right. When you have short-term, medium-term, and long-term momentum indicators all just flattening out and intersecting, it means the institutional algorithms and, algorithmic traders have no directional bias.
Yeah, the market is basically holding its breath.
But I have to ask you, looking at the macroeconomic landscape, is this hesitation at 65,000 a sign of fundamental weakness? Or is it just the market catching its breath after a wild ride?
It's a profound case of digestion, really, but it's complicated by opposing macroeconomic headwinds. You basically have two massive forces neutralizing each other right now.
Okay, what's the first one?
On one side, there is this measurable relief flooding the market because the geopolitical tensions between the U.S. and Iran have, momentarily eased.
Oh, right.
So the risk premium that gets priced into global equities, especially regarding Middle Eastern energy supply chains, that's contracted.
Which naturally pushes the market up.
Exactly. But pulling it down with equal ferocity is the semiconductor and broader tech sector, which is just exhibiting severe fatigue.
The tech fatigue is the anchor here. And that sector rotation is being supercharged by valuation mechanics. We all watched AI and semiconductor stocks just multiply in value since the start of the year.
Yeah, the run-up was historic.
It was. But the problem is that current stock prices represent future growth expectations. So right now, AI valuations are like a pole vaulter who has set the bar at a world record height.
That's a great way to put it.
Right. Merely clearing that bar just meets the baseline expectation. But grazing it is treated as this systemic failure.
Yeah, the expectation compression is severe. Institutional investors realize that when a sector is priced for absolute perfection, the upside risk is marginal, but the downside risk is just catastrophic.
Right, because perfection is priced in.
Exactly. An AI firm can report record quarterly profits, they can beat their top-line revenue guidance, and still see a massive sell-off simply because the rate of forward growth didn't accelerate fast enough to justify the multiple.
Wow, so capital preservation instincts just kick in.
Yes, prompting a really strategic retreat.
And here's where it gets really interesting, because that capital isn't exiting the Japanese market entirely. It's aggressively rotating.
Yes, very aggressively.
Going back to that movie analogy, it's like if AI is a blockbuster sequel where expectations are so impossibly high, it's basically doomed to disappoint, investors are retreating to the indie theater, right? They're moving to reliable domestic stocks.
Yeah. We are seeing heavy institutional flow moving out of tech and directly into lagging entertainment stocks, and critically domestic demand sectors.
And that domestic rotation isn't just random, is it?
No, not at all. The rotation into domestic demand is a highly calculated front-running of fiscal policy. It is entirely driven by the anticipation surrounding the Takachi administration's upcoming food consumption tax cut.
Ah, the tax cut.
Yeah, from a corporate balance sheet perspective, the mechanics of this policy are incredibly potent for domestic equities.
Because it fundamentally alters discretionary income models, right?
Yeah.
Like, if you structurally lower the tax burden on non-discretionary items, basic groceries and stuff, that capital doesn't just sit in a consumer's bank account.
Right, it gets reallocated.
Exactly, further down the spending hierarchy. So suddenly, families have a wider margin for eating out at restaurants, paying for domestic services, or spending on entertainment.
And furthermore, retail and consumer service corporations, they operate on relatively thin margins compared to, say, software or semiconductor companies.
Sure.
So a marginal increase in top-line consumer spending, driven by this exact tax relief, translates to a disproportionately large percentage increase in their net operating profit.
Wow. Okay, so institutional models are basically pricing in this upcoming earnings expansion.
Exactly, which is why we see this domestic rotation propping up the broader index while tech bleeds.
But the reality of market weighting means that, the indie theater of domestic stocks can't carry the Nikkei past 65,000 all on its own.
No, absolutely not. The heavyweights still dictate the overarching trend.
Right. For the broader index to break out, the AI narrative has to prove its structural integrity. And that thesis gets aggressively stress-tested this week with hard data, right? Because we have TSMC releasing their July sales data on August 10th.
Yeah, and as the foundational foundry for the global semiconductor ecosystem, TSMC's monthly sales figures offer the most unfiltered look at actual realized AI hardware demand.
It cuts right through the speculative noise.
Exactly. And then following that, on August 13th, Applied Materials releases their earnings, and they provide the capital equipment necessary for foundries to even manufacture those chips in the first place.
So the forward guidance from Applied Materials is essentially a roadmap for capital expenditure in the tech sector over the next, 3 years?
Pretty much, yeah.
Right.
If foundries are buying their machines, it means they're forecasting sustained multi-year demand.
So if both TSMC and Applied Materials report data that validates these current high-altitude valuations, that provides the fundamental justification needed to uncoil that technical spring at 65,000,
Right.
to push their Nikkei into a new upward channel.
Yes. But conversely, a miss from either of them will act as an accelerant to the domestic rotation we just outlined. Capital will flee to high-beta tech names even faster, just seeking the relative safety of the Takachi administration's fiscal stimulus environment.
Wow. But, the rotation into domestic stocks isn't happening in a vacuum. It's deeply intertwined with the other massive structural force dominating the statistics this week, which is the currency market.
Oh, absolutely.
The Takashi administration's policies are driving the yen,
Yeah.
and the USD-JPY exchange rate is basically functioning as the foundational floor for the entire Japanese equity market.
And the currency dynamics are incredibly strained right now. We recently witnessed coordinated intervention by the U.S. and Japan, a massive brute force injection of liquidity aimed at shocking the market.
And it temporarily succeeded, right? It drove the dollar down roughly 9 yen to the 155 yen range.
Yeah, and in the foreign exchange world, a 9-yen swing is a tectonic event.
Massive. But the official statistics for this week show the yen is already depreciating again. It's creeping back up to the 158 level against the dollar.
Yeah, it's bouncing back.
Which presents this glaring macroeconomic contradiction. I mean, you have the Ministry of Finance intervening to artificially prop up the yen, but simultaneously the Takachi administration is running aggressive expansionary fiscal policies like the food consumption tax cut and expanded budget deficits.
Right.
Basic macro mechanics dictate that increasing the domestic money supply to fund fiscal stimulus inherently creates structural downward pressure on the currency. So aren't these massive government currency interventions just fighting the tide?
Well, if we connect this to the bigger picture, that contradiction is the defining feature of the Japanese economy in August 2026.
The Ministry of Finance is burning through foreign reserves to defend a currency that the broader government's fiscal stance is actively diluting.
Exactly. However, this stubbornly weak yen, hovering around a 158, is actually providing a critical structural defense mechanism for the Nikkei.
Because it's vital to parse out the difference between the domestic consumer economy and the corporate export economy here. Right?
Yes, exactly.
I mean, a weak yen is highly inflationary for the average citizen importing food and energy. But for the multinational conglomerates that dominate the upper echelons of the Nikkei and the TOPIX, a 158 yen exchange rate is a massive structural advantage.
Yeah, the translation effect on corporate balance sheets really cannot be overstated. Japan remains an industrial and export powerhouse.
Right.
So when automotive manufacturers, heavy machinery producers, electronic component makers sell their goods in the US or Europe, they are paid in dollars and euros.
Sure.
And when they repatriate those revenues and convert them back into a depreciated yen, their reported domestic profits swell artificially, purely based on that exchange rate differential.
So even if global demand for their physical products remains entirely flat, their profit margins just expand on paper simply because the yen is weak.
Precisely. That exchange rate premium creates a massive buffer of profitability. It is basically the invisible scaffolding holding up the Japanese equity market right now.
Fascinating.
Yeah, this repatriated profit windfall is absorbing the downward drag created by the semiconductor sector's valuation contraction.
Right, because if you imagine a scenario where the Ministry of Finance's interventions were actually successful, right, and the yen strengthened back to, say, 140 to the dollar, simultaneously with the current tech sector fatigue.
The Nikkei wouldn't be coiled at 65,000. That scaffolding would vanish, and the index would undergo a severe rapid correction.
Wow. So the weak currency is essentially subsidizing the broader market stability while it waits for tech to figure itself out.
Yeah, that's exactly what's happening.
Which brings us to the statistical forecast for the week ahead, because these converging moving averages, they are not going to hold forever.
No, they can't.
The official outlook projects a trading range for the Nikkei between 63,500 and 66,500. And for the currency, they forecast a USD/JPY range between 157.00 and 160.00.
And that 160 mark is not just a technical ceiling. It is a profound psychological barrier.
And everyone is watching it.
Everyone. The market collectively understands that 160 is the threshold that triggers alarm bells at the Ministry of Finance.
Right.
Every time the exchange rate tests that boundary, institutional algorithms price in the rising probability of another unannounced multi-billion-dollar intervention.
And the 157 mark, conversely, that represents the hard support floor established in the wake of the last coordinated intervention.
Exactly.
But what makes these ranges incredibly dangerous this week is the liquidity environment, right? I mean, we're entering the Obon holiday period in Japan, with Mountain Day falling on August 11th. So when domestic institutional market makers step away from their desks, market liquidity just evaporates.
It does. And the reduction in trading volume widens the bid-ask spreads and removes those institutional shock absorbers that normally dampen volatility.
It creates a dry, powder keg environment. When liquidity is thick, the market can absorb a surprising macroeconomic data print with just a modest adjustment. But in a thin, illiquid holiday market.
Yeah, that exact same data print acts as a match. Price discovery becomes violent, algorithmic stop losses get triggered in a cascade, and we see massive, exaggerated directional swings.
And someone's about to throw several matches into that powder keg. While Tokyo's on holiday, the international macroeconomic calendar is heavily loaded.
Oh, heavily loaded.
We have the U.S. July employment data setting the baseline, and that's immediately followed by the U.S. Consumer Price Index, the CTI, on August 12th, and the Producer Price Index, the PPI, on August 13th.
And those inflation metrics dictate global capital flows right now, and the stakes are significantly higher because of the hawkish rhetoric coming out of the U.S.
Right.
Federal Reserve official Warsh has openly stated a readiness to execute another interest rate hike in September if these specific inflation metrics show acceleration.
And a September rate hike would be a brutal shock to a market that has spent the last 3 months aggressively pricing in a trajectory of monetary easing.
The divergence in central bank policy would immediately re-widen.
Not to mention the geopolitical wildcard operating in the background. The U.S. and Iran are currently engaged in high-level negotiations.
Which is a huge factor.
If they formalize a re-agreement, the immediate removal of Middle Eastern geopolitical risk could trigger a massive upward breakout, sending global equities soaring.
Yeah.
But if those talks collapse, sending oil futures spiking and risk premiums soaring, the index could break downward through that 63,500 support level just as quickly. So how does a retail investor navigate this?
Well, this raises an important question for anyone navigating the markets this week. How do you filter the signal from the noise when algorithmic trading is reacting to high-impact data in an illiquid environment?
Right.
The key is to look past the immediate equity headlines and focus relentlessly on the currency metrics, specifically the reaction at the 160 yen ceiling.
Because the currency market dictates the structural reality for the Japanese exporter.
Yes.
If U.S. inflation data prints hotter than expected on the 12th, algorithmic models will instantly price in a higher probability of Warsh's September Fed rate hike.
Exactly.
Yield spreads between U.S. Treasuries and Japanese government bonds will widen, driving capital into the dollar and pushing the USD JPY rate violently upward against that 160 ceiling.
And at that exact moment, the Bank of Japan and the Ministry of Finance are backed into a corner.
Right. What do?
Do they burn more foreign reserves in an illiquid holiday market to defend 160? Or do they capitulate and allow the currency to slide further into uncharted territory?
Wow.
The outcome of that specific central bank decision will have a vastly more profound impact on the long-term profitability of Japanese export stocks than a transient miss in tech earnings. The semiconductor narratives generate the daily headlines, but the underlying currency mechanics dictate the fundamental valuations.
Yeah, that makes so much sense. So let's synthesize the actionable takeaways for you, the listener, for the week ahead based on the published statistics.
Sure.
First, technically, monitor that 65,000 resistance level on the Nikkei closely. Watch the interaction of those converging moving averages to see which way the volatility expansion breaks.
Definitely.
Second, fundamental tech valuations face a reality check with TSMC's data on the 10th and Applied Materials earnings on the 13th.
Right.
Finally, macroeconomic risk peaks midweek. Brace for the U.S. CPI and PPI data on the 12th and 13th, keeping your primary focus on how the USD JPY exchange rate reacts as it approaches that critical 160 threshold.
It is basically the textbook definition of a high-stakes week. The combination of thin holiday liquidity, massive U.S. inflation data drops, and semiconductor bellwether earnings guarantees extreme volatility.
So what does this all mean? We've spent a lot of time analyzing the calculated rotation into domestic stocks, the entertainment and food sectors, spurred by the Takaichi administration's upcoming tax cuts.
Yep.
It feels like a logical, safe harbor for capital, while the AI sector digests its astronomical valuations. But I want to leave you with a different perspective to mull over as you watch the price action this week.
Okay, let's hear it.
If U.S. inflation runs hot and the Federal Reserve genuinely executes a rate hike in September, the resulting dollar strength will inevitably smash the yen through that 160 ceiling.
Right.
If the Bank of Japan is subsequently forced to execute a massive defensive currency intervention, just as the Takaichi administration's tax cuts inject a wave of new yen liquidity into the domestic economy, are we looking at a systemic contradiction? Is the Japanese government essentially funding the collapse of its own currency defense? And in a scenario where those global macro forces collide and tear down the broader market scaffolding, is this current cozy rotation into domestic food and entertainment stocks truly a safe haven? Or is it merely a temporary illusion of safety? Keep that paradox in mind as you watch the data roll in. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.